Fed Chair Jay Powell did not indicate the scope of those rate cuts, as Steve points out. Our next guest says he's expecting the Fed to ease by a full 0.5% in September and November and a 1/4 point in December. 1.25% total by the end of the year. Joining me now is Jay Bryson, chief economist at Wells Fargo. That's certainly, Jay, a little bit more aggressive than I've heard most of the people I've spoken to say. Why do you think the case is there for a full percent split between the next two meetings of cuts?
You know, Dom, what I would say is, and Mr. Powell kind of alluded this today, is, the labor market is starting to weaken. Inflation is coming back down towards 2%. And generally, what it really boils down to is the stance of monetary policy right now is very restrictive. And, we measure that by the so-called real Fed funds rate, the nominal rate minus inflation. And that's close to 3% right now. We haven't been at these sorts of levels since 2007. And so they have a lot of wood to chop just to kind of get back to neutral, and they kind of need to get going back in that direction as the economy continues to show some signs of stress.
As an economist, has it surprised you at all? You've seen many of these cycles. You still look young enough, but we know that you're a veteran and you've seen a lot of these cycles. Is it shattering to my mind, though? It's shattering to my mind how quickly we went from being all fearful of 40-plus year inflation levels to now being concerned about a weakening job market and a slowing economy, to the point where you think the Fed would have to cut by a full 0.5% at its next meeting to kick off a cycle, possibly.
So Dom, we'll go back a few decades here. So if you go back to November of 2000, in November of 2000, the Fed had a, quote, bias to tighten. In December, they had moved to a neutral bias. And on January the 2nd, 2001, in an intermeeting move, they cut rates by 50 basis points. Sometimes, that's just the way the economy works sometimes. Sometimes it deteriorates really quickly. And then on the flip side, when you think back to 2002, when inflation really shot up, inflation shot up really quickly, and the Fed had to move really, really fast. So what's more likely when you look at history is the Fed funds rate tends to move in a lot in a direction, rather than going 25 basis points, waiting a meeting or two, going another 25 basis points. The big swings are more normal.
How much does the Fed this time around have to factor not just those things that we mentioned with regard to the kind of, downdraft of inflation and the slowing economic jobs growth picture, juxtaposed against an election that might, in some people's minds, create some kind of economic policy variability and volatility? How much does that factor in to the Fed's anticipated decision in just a few weeks' time?
So, nobody really obviously knows what's going to happen with the presidential election. We'll start there, but even the congressional election. And so, even if you can make some sort of assumptions there, you can make some sort of forecast, those things really won't come into play until the middle part of 2025, probably at the earliest. And so, what the Fed has to be doing right now is looking at the incoming sort of data. What's that saying about the economy? The politics behind it is a little bit of background noise. And once the smoke from the election clears and they have a little bit of a better sense of what sort of policy changes may be coming from the new administration and from Capitol Hill, then they can start to adjust their policy guidance at that point. But right now, they've got to be laser focused on what's really happening in the economy.
All right. Jay Bryson at Wells Fargo with a call of 1.25% worth of cuts at the Fed by the end of this year. Thank you very much, sir. We'll talk to you soon. Have a nice weekend, Jay.